what is margin? Right? What is margin? So when trading forex, you just need to put a small amount of capital into your account in order to open a position. If you want to place a trade, you will need to put money in your account before you do that. Just a small amount of money. You don't need to put. Okay, so for example, if you want to buy $100,000 worth of GBP USD, you don't need to put up the full amount. You don't need to put up the $100,000. You only need to put a portion, like just a portion of that 100,000, like just a little portion, even if it's maybe $1,000 or $2,000, depending on your broker. So the actual amount depends on your forex broker or your CFD provider. So margin can be taught as the deposit or the collateral that is needed to open a position and keep it open. So it's just the assurance that you can afford to hold the trade until it is closed. Okay, so margin is not a fee, it's not a transaction. It's not a fee or a transaction cost. It's not a fee, it's just the money that your broker, the portion that your broker will set aside from your account balance to keep your trade open and to ensure that you can cover the potential loss of the trade. That is, in case if you lost the trade, your broker, the one that they set aside, which is the margin, the one they set aside is the one that they will now release to you. So how do you calculate your margin? For example, you decide to buy one lot size of Euro USD, and the price at that point was at 1.1030, and the leverage provided by your broker was 1:100. So how do you calculate your margin at this point? So what you just have to do is just say margin is equals to 1 times 100,000. So that 1 times 100,000 is the lot size you are using. Is the lot size. So you know one lot size is equals to 100,000, right? So you're saying 1 times 100,000 times 1.1030, which is the current price of the Euro USD at that point, divided by 100, which is your leverage. And remember, you chose leverage is the leverage you chose is 1:100. So you are dividing it by 100. We're dividing the 1 times 100,000 times 1.1030 divided by 100. And if you do this math, it's going to give you $1,103 US. So you need $1,103 US to enter this trade, to buy Euro USD with one lot size. In order to enter a position with one lot size, you will need $1,103 US. So in case if there is insufficient funds, as you're trying to buy is saying insufficient funds, all you have to do is to increase your leverage, right? All you have to do is to increase your leverage. So how do you, after increasing your leverage, how do you calculate your margin? You will do the same thing by saying 1 times 100,000 times 1.1030 divided by 500. So let's say you are using 500. We are choosing 1:500, right? So right now you'll be dividing it by 500. Whichever leverage you use. If you use 1:200, you divide it by 200. If you use 1:500, you divide it by 500. So we are using 500 now. So you say 1 times 100,000 times 1.1030 divided by 500. If you do the math, it's going to give you $220 US. So the amount of the required collateral decreased by 5 times. So $220 is the amount you will now need in order to place a position on Euro USD to buy one lot size on Euro USD. There isn't one lot size to buy, so you're going to be, needing $220 to, enter the trade. So as the trading volume is decreasing, the margin requirements will decrease as well. Okay, so I know this is kind of confusing, so you just have to rewatch the video over again, and then I know you will understand it. So what is free margin? What is free margin? Free margin is an indicator of the amount of money in the account that can be used to open additional trades. So if there are no additional trades, if there are no any opened additional trades, if there are no opened trades on your account, the free margin is equals to the balance and the equity. So in the next video, I'll be talking about equity. Okay, so free margin is the amount of money that can be used to open additional trades. So when you see your free margin that is high, you know that you have, additional, like you still have chances to open more trades in your account. So free margin is an important indicator, because it will indicate to you that, okay, you have free margin to open more trades. And if you don't have free margin, it will also indicate to you that your free margin is very low, and you're not able to open more trades. So in case you want to increase your free margin, it's just by also increasing your leverage size. Okay, so thank you for watching, and then I'll catch you in the next video.